this content, you finally do the responsible thing. You start saving money. Every month, you move a little bit into your savings account.
$200 here, $400 there. You feel good about it, responsible, disciplined, financially mature. But then one day,
you open your banking app and realize something strange. Your savings account has $20,000 sitting there, and it's earning
something like 1% interest, which means after an entire year, you've made $200. Meanwhile, you keep hearing people talk to you
about investing stocks, index funds, compound growth, and suddenly you start wondering, wait, am I doing this wrong?
because saving money is good, but saving alone rarely builds real wealth. And this is where a lot of people get stuck. They know
saving is important, but they have no idea how to transition from saving to investing. So, in this video, we're going to break down.
We guide you step by step, turning your savings into secure, growing investments. My name is Setha. If you're someone who has money sitting in savings but isn't sure how to start investing it,
let's start with something that might sound controversial. Saving money alone will almost never make you wealthy. Look, saving is
important, but it's not the final goal. It's just the first stage. Because here's the thing, savings protect your money. Investments
grow your money. And those are two very different jobs. Let's look at the math for a second. Imagine you save $1,000 in a typical
savings account earning 1% interest. After 1 year, you have $1,010. Not bad. But now, let's compare that with investing.
Historically, the S&P 100 stock market has returned about 10% per year on average over long periods. If that same $1,000 earned 10% annually, after 1 year, you'd have $11,100. Now that difference might not seem huge at first, but here's what most people don't realize: compounding over time. After 20 years, savings at 1% equals about $12,200. Investing at 10% equals about $67,000. X. Same starting money, completely different outcome. And this is where it gets really interesting.
People who invest. But here's the problem. Most people never make that transition. And the reason isn't math, it's psychology.
Saving feels safe. Investing feels risky. When your money sits in a savings account, you can see it. It doesn't fluctuate. It doesn't drop
5% in a random Tuesday afternoon. But investments, they move. Sometimes up, sometimes down. And that emotional volatility scares people away. Now you might be thinking, okay, Setha, but I don't want to lose my savings. Totally fair. And that's
exactly why the transition from saving to investing should happen in stages, not all at once. Let's walk through the step-by-step. Step 1. Build a real emergency fund. Before you invest a single dollar, have 3 to 6 months of living
expenses saved in cash. This money stays in savings. It's not for investing. It's not for opportunities. It's for unexpected
problems, job loss, medical emergencies, car repairs. Because here's what most people don't realize. The biggest reason
people panic sell investments is because they need the money too soon. An emergency fund protects your investments from
your own life. Step 2. Separate saving from investing mentally. This is huge. Think of saving and investing as 2 different buckets.
Bucket 1, safety money. Bucket 2, growth money. Safety money doesn't move. Growth money is allowed to fluctuate because its job is to grow over time. This mental separation reduces anxiety dramatically.
Step 3. Start investing small. Look, a lot of beginners think investing requires thousands of dollars. It doesn't. Many brokerage. Step 3. Start investing small. Look, a lot of beginners think investing requires thousands of dollars. It doesn't. Many brokerage
habits matter more than timing. Step 4. Focus on simple investments first. Here's where beginners often make a mistake.
Investments often outperform complicated ones. For example, index funds. These funds track the overall stock
market. Instead of trying to pick winning companies, you're investing in hundreds of companies at once.
Invest $300 per month into the stock market. If the market averages 8% per year, after 25 years, you'd have roughly
$285,000. 45, but here's the crazy part. You only contributed $90,000.